Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I am your host, Bob Pisani. We have been telling you about this potentially record year for ETF launches. You've heard it from Verify. More than 288 new ETFs have already launched this year, well beyond the 120 new launches the same time a year ago. And at this pace, we could see 1,000 new ETFs in 2025. That would be a record, and trust me, it's a lot more than I can follow. Leading the pack are active ETFs. So let's talk to one of the leaders in active ETFs, John Mayer, is Chief ETF Strategy for JP Morgan Asset Management. Also joining us, my old friend Mike Akins from ETF Action. John, you're the wise man here. What are the major trends in active we're seeing year to date? And what are the lessons investors should take from this wild month of trading in April? It's really a head-spinning month.
First of all, Mike and I were talking earlier, there's almost parity between passive and active ETFs, 2,000 plus of each. So the actively managed ETFs are taking over the marketplace. About 10% of the assets, about 40% of the flows. And what we're seeing is that particularly in times of stress, like we are seeing right now with the twists and turns with the tariff story, an active manager really can do bottoms-up research, really focus on individual companies, and can find a better outcome for investors, because this is a very difficult market to navigate, and having a tremendous amount of resources behind you is really helpful.
You know, Mike, this is shocking news. An active manager says that active management really does matter. This is definitely a groundbreaking piece of information here. But he does have a point here about trading in general for this month. I want to talk to you about this. But you know, the maximum drawdown for high to low on the S&P in April was almost 13%. I mean, I want to talk about it this month. And now, what are we down? 1.5%, Mike, for the month on the S&P? And I guess what I'm trying to do is, what should investors take away from this kind of head-spinning activity?
Well, I think staying the course is really important, but that kind of plays into the active story that I think John and a lot of other people are talking. You know, just last week we saw, net outflows into equity ETFs of almost $1 billion, but active ETFs saw almost $3 billion in inflows, where passive saw almost $4 billion in outflows. So I think the story around active, especially in the traditional asset classes, so the traditional buckets, strategic allocations to the size and style boxes, to fixed income core enhanced, is that active management can do your tactical trading for you. They can change around this, based on the macro environment, while letting the investor stay the course. And that's a little easier to do in an active framework than it is in a passive framework. And I think that story is playing out in the marketplace.
But Mike, and you and I have been saying this for a year now, that the old school active that you and I think of, active, old school, old-fashioned stock picking, is really a subset of active management these days. A lot of active management, like Dimensional, for example, or Avantis, they're sort of active plus. They have a value small cap overlay to them, but it's not active in the sense that you and I understand traditional stock picking. Now, a lot of JP Morgan stuff does, absolutely does. But I just want to make that distinction with everyone. You agree with that, right, Mike? About you can slice and dice active in a lot of different ways.
Active can be very, can look, closet indexing in active management has existed forever and still does. But I think if you break down the ETF market, most of the newer active managers, JP Morgan, T. Rowe Price, John Hancock, it's traditional bottom-up analysis on the portfolio. And if you look at the R squared of the portfolio, if you look at that correlation, it's going to be a little bit lower. So I think, yes, DFA, Avantis are more quant shops that are active by default, but have very high overlap to the broad major composites. That's a very fair statement.
Well, let's talk about what you guys do. You oversee the largest actively managed ETF in the world. I don't know if people know that. It's the premium income ETF. We call it JEPI, folks, J-E-P-I. And it seems to have scratched a real need for investors to have some downside protection at the same time and generate income. But let's not assume everybody knows what this is. How does JEPI work, and why has it been so successful? What do you own when you own JEPI?
Well, I think investors, for the longest time, interest rates were very low for a very long time. Investors really seeked out a high yield, and JEPI provides that between 7 and 9%.
What do you own when you own JEPI?
Well, you own two things with JEPI. You own the underlying holdings, which is actively managed by a management team, active management, JP Morgan, And then you own index options written on the actual portfolio. Now those index options are written 2% out of the money. They're rolled on a weekly basis. And when there's increased volatility in the market, when the VIX increases, that offers the opportunity for an increased amount of income to the investor of JEPI. Conversely, when the volatility declines, given that the options are written out of the money, it provides some upside in the underlying portfolio.
Now you say it's actively managed, but essentially it's the S&P 500, right? I mean, how much deviation is there from what you're owning?
You're getting 60% of the volatility of the S&P 500. You have two parts. The underlying portfolio is absolutely actively managed, but with an option overlay, you are selling most of your
S&P options.
Yeah,
right?
S&P index options. You're selling most of your upside in exchange for income, but you're still offering the opportunity for some upside because they're out of the money options.
What kind of income are we generating?
It's about 9-10% right now.
Yeah. Mike, this was one of the great successes a couple of years ago, and it did strike a chord for people who wanted to still be in the market but generate income. A lot of investors are getting older; they want income. We see a lot of copycat JEPIs that are out there these days.
Yeah, this has been a huge area of the market. Kind of falls into that bifurcated market where you have folks that are really risk off with buffer ETFs and synthetic income, where you're going to have a lower upside and downside captures, and folks that are going head first into leverage inverse. But the synthetic income continues to see significant amount of inflows into this market. And one thing I just note on the JEPI, it is a very actively managed portfolio. It has only about 40% overlap with the S&P 500 in that capacity. There are a lot of covered call strategies out there that mimic the S&P 500 in terms of their holdings, but JEPI is actively selecting those companies in the portfolio and looks very different than the S&P 500.
Yeah, I want to just move on here. We're also seeing big inflows into ultra-short bond funds. Your main fund, JPST here, ultra-short, what, 4.5% yield? And tell us about this again, actively managed, short-term investment grade corporate debt. What's in this?
Yeah, it's about 55%. It has a duration of 0.75. It's a fully investment grade portfolio as commercial paper, investment grade bonds, and short duration. So,
is there treasuries at all?
There's no treasuries in the portfolio. So, if you look at the 10-year treasury has gone from 4.9 this year to 4.2%, and this fund yields 4.5% yield to worst. It provides a ballast in your portfolio, stability for those investors that are looking to protect principal. And it's really, the ultra short space has been an area in the active space that has been tremendous flows.
Love it. I mean, 4.5%, you're effectively getting what, a 2%, 1.5% real yield and take out inflation. I mean, investors, they're incredibly sticky. Our viewers love them. They love their money market funds. It's real competition for stocks, don't you think, at this point? Finally, after how many decades has bonds been no competition for stocks?
I think in the active space, fixed income is an area that's really can benefit from active management. It's a very complex market, just generally. And I think 70% of the market is actually active overall in fixed income. Putting active, using the ETF structure and using active management inside of the ETF structure really is beneficial to clients, both on short term as well as intermediate as well.
Yeah, I want to move on. Mike, any thoughts on short term, ultra short bond investments?
Yeah, I mean, other than that, it's over almost 60% of all fixed income flows year to date is into short term and primarily ultra short. So this category is where people are hiding out to weather the storm in terms of where they're actively allocating and increasing allocations. Ultra short is seeing tremendous flows and is driving fixed income overall ETF flows.
Good. Let me move on and talk about equities. International equities have held up a lot better this year than people thought. When the investors looking to diversify away from U.S. stocks, essentially. So you, JP Morgan, you oversee several big ETF funds for Japan, for Canada. These are market-weighted indexes, right, of stocks in those countries. They're up in the low single digits this year. I was looking at them this morning. They're outperforming the U.S. for the first time in years, really. I'm specifically Japan and Canada here.
Yeah, we've seen flows into BBJP and BBCA. There has been an increased appetite for international investing, obviously with the environment that is currently going on right now. I do think the better way to play international right now is through active management. We have a fund called JIRE, J-I-R-E, that looks at funds, it looks at companies in different sectors, and again, bottoms up research. It doesn't veer far away from an index, but it's an actively managed approach. And if you think about international, how many international companies does the average investor know? Not many. So handing that investment process over to an active management team really makes a lot of sense. And you are seeing a huge amount of flows. And one interesting stat, there's only been 2 European ETFs that have been launched over the past 6 years. The market's really behind on European ETFs.
Yeah, but this is market weighted though.
BBJP and BBC, yes, that's correct.
And we showed these. Look here you go. Well, here's JIRE. But if you put back Canada and other ones like Japan, it's remarkable. Look at that V shape for the last month, and you look at this and you can't help but, as an investor, draw some conclusions about not trading around when the market panics. Don't do panic trading. I mean, I know this is an old story. We've been talking about it since Jack Bogle for 40 years, but it really bears repeating here. Don't do anything stupid when the market is crazy. I mean, what's your position on this?
Well, think about it. What we've experienced over the past few weeks, we've had 5 and 7% down days. A few days later, we had a 10% up day. So if you missed that 10% up day and you got scared and sold on the 5% down day, that really impacts your long-term returns in a portfolio. So it's not about timing the market. Again, it's about time in the market. And sometimes it's hard and sometimes it's painful. But if you have that wherewithal over the long term, you're probably going to benefit.
But isn't the point then, and I'm pulling out the stock Sherpa and you the old wise man, is to have a plan and to stick with the plan. The studies are very clear. People tend to underperform their benchmarks because they do silly things like trying to trade themselves out of situations they're uncomfortable in. When most of us know it's better to do nothing. Jack Bogle, who's the man who had the biggest influence on me, the founder of Vanguard, used to say, don't just do something, stand there.
It's better to do nothing in a sense, but you have to kind of understand your risk profile, your risk tolerance, time horizon, how long you need to be in the market, retirement, all your goals. So I think that's really important as well. And that plays into diversification, whether it be into fixed income, into derivative income like JEPI or JEPQ, or short-term instruments like JPST. You can build a portfolio of actively managed ETFs to cater to your risk profile and risk tolerance.
Mike, it's amazing watching all of these alternative products out there to provide some kind of downside protection, these alternative ETFs that are out there. So you mentioned we've had buffer strategies on, synthetic income like JEPI, leverage and inverse ETFs, including leverage and inverse single stock ETFs, options over it. Look, I have a little list here that everybody can read just to try to make sense out of all this. But these products have not been around that long. The buffer's been around for a little while, but there seems to be a real interest in this. Is it because people are getting older? They got spooked by some of the downside we've seen in the last few years. Some people want income. What's sort of driving these? I call them alternative ETFs, but I'm not sure what you would call all of these together. But it's really interesting watching them expand dramatically in the last few years.
Yeah, I mean, I think you can really break it into 2 halves, right? So you have the younger generation of kind of YOLO, if you will, really leaning into the leverage inverse strategies. The single stock leverage into ETFs have seen $10 billion of inflows year to date, and that's really primarily levered single stock names, and they tend to be the most volatile single stock names. All evidence suggests that that's not institutional money. If you look at 13F holdings, less than 5% of these things are held by institutions. So it's being driven by the retail trade. Now, the counter side of that is the buffer and synthetic income. And I think if you look at the ownership of that, it's primarily driven by institutional ownership, RIAs that are allocating their clients to this. And I think two things can be played there. One is, I think everybody's agreed for a while, we've had historically high valuations. The market kind of needed a reset. And so people were a little bit risk off anyway. But then also, you've had this period of really, how do you allocate into fixed income? So a lot of folks are looking at different ways to allocate some of their fixed income bucket into something that might have similar beta construct or similar up-down captures to that side of the market, but do it in a way where they can still meet that income need and gain some of the return structure of the overall equity market. So a lot of big macro trends on the institutional side, and I think on the leverage inverse side, it's just an idea of more and more people embracing the stock market, more and more Robinhood type traders that are willing to do some crazy stuff.
Well, what I like about these, I've had problems with leverage and inverse single stock ETFs because I think they encourage excessive speculation. But a product like JEPI, this product makes some sense to me. Here's an older investor, I want to stay in the market, but I need to generate a little more income. I'll give a little upside, which is what you do with JEPI, for the income. This seems to be a product that makes some sense for me. If I'm an older investor, I'm smart enough to know I'm not going to pull out of, I shouldn't pull out of the market. That's not a good idea. So, but I do need to have some kind of protection. And even some of these buffer ETFs, they act sort of like a collar in a way, make some sense to me. If I'm an older investor and I'm smart enough to know, don't get out of the market, but is there some way I'll pay something to provide some kind of, I'll give up a little upside protection to provide some protection on the downside, you know, sort of collar me a little bit. These products make some sense to me. As an older fellow, I'm almost 70 years old, folks, so believe me, these things make sense when you get up into my age group.
Yeah, lower volatility in the market, consistent income during periods of volatility like now, increased income, and potential upside on the underlying portfolio as well, not completely selling the upside. I think that's important.
And any thoughts on, and I know you're not the ETF Sherpa here, but you are the strategist. What's going to become popular the rest of this year? Bitcoin ETFs were the biggest thing last year. They've kind of quieted down this year. We see other active kind of products coming in to fill a need. Do you have any sense of where demand is going to be for the rest of the year?
So, you know, I talked about earlier that we're pretty much a parity between active and passive ETFs. Obviously, the asset base is much different. And what I'm seeing is that there's a gradual move towards the more traditional asset classes, like large cap growth and large cap value and international. And as the ETF structure just becomes that much more accepted, because there's so many things you can do inside the ETF, in terms of both from a portfolio manager standpoint as well as the individual investor. I see over time, and particularly potentially with ETF share class coming to market potentially this year, a movement towards those more traditional asset class because it's just a better structure.
Yeah, it makes a lot of sense. And as Mike and I have pointed out, Mike writes about this regularly, the overall flows still are passive plain vanilla. The largest flows still are in that passive plain vanilla space still.
Yeah, but the flows this year are approximately 40% of the flows have been active, despite that only 10% of the assets are active.
Smoking like an active manager here, Mike. We keep getting, we're getting the same story all the time. Mike, any quick thoughts here on where we might going on for the rest of the year?
Yeah, I would expect to continue to see a bifurcated market where you have the traditional space is going to keep taking 80-90% of your assets. And I think John lays out a good story for why you're seeing more and more active share in strategic allocations. But if you look at from there, you're going to continue to see kind of the spicy side of the market grow. I think we'll see more and more leverage inverse. Every weekend when I sit down to review all of the new launches, I just shake my head on the leverage inverse single stock side. But then also, I think you'll see more and more innovation on the synthetic income, the buffer ETF strategies that provide kind of an equity light version of the marketplace. So that's that. I don't see anything big like crypto like we saw last year, but I just think a continuation of some themes that we saw start last year.
All right, that makes a lot of sense. Appreciate that, Mike, as always. And that does it for this week's ETF Edge. My thanks, of course, to John and to Mike. And we've asked Mike to stick around and provide us some additional perspective on ETF trends. He has all sorts of thoughts. That's coming up on the ETF Edge podcast. And remember, you can see all of our shows on our website. This is our 7th year, folks. etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.